Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by a Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with a Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. Okay, we're back for another episode of the Mortgage Broker Podcast, and today we're actually looking to unlock the MIC Playbook. We have some insights from Ben Sammut, our guest today. Thank you, Ben, for joining us. Derek Williamson, my partner, is also joining me as a co-host, so really looking forward to getting into this. Ben, I would consider you a renowned consultant at this point in the private lending sector, primarily specializing in mortgage investment corporations. There's a lot more to that as well. And yeah, thanks for joining us, man. Looking forward to getting into this.
Thank you guys for having me.
Awesome. So I do want to add a connection. Ben is actually the son of Joe and Andrea, who are our partners in Ontario. We're actually recording in Ontario today. I wanted to point that out because your family, and this is a bit of an introduction to yourself, is like the prototypical financial family in the mortgage channel.
I am a broker kid, yeah.
So yeah, let's just start there. Like just a brief introduction to you, how you found this industry, because I know it's obviously a big part of it is your family.
Mm-hmm, absolutely. So when I graduated university, I'll be honest, I wasn't too ambitious in finding two job opportunities. And the one internship that I had fallen through. So I was already licensed as an agent to help my dad with admin stuff when I was younger. So I started brokering sort of part-time and then eventually kind of grew into it, realized I had a bit of a knack for it. And then, the opportunity of working with a larger book, I got to progress a bit quicker than your average agent would. The average agent has to come in and get their slice of business. I was already coming into a fairly large book working with higher end clientele. And so that was, I guess, an accident how I got into it, if you will, even though I am a bit of a broker kid, or the Nepo babies, as they're saying today. But I loved it, and it was a good fit.
And so like that introduction to the industry and working on client files, I'd imagine that's where the light bulb potentially went off from the private lending side, right? You obviously would have worked on conventional files, alternative files, and private. And I mean, I don't know how long you've been doing this for. I'm curious, but private has been, a massive part of our industry, and it's been growing at a substantial pace, which comes with challenges and reward, right? But what triggered you into the private sector?
Yeah, so this will be my 13th year in the industry full time. And back in 2017, 2018, when all the B20 regulation came in, I realized that it was becoming increasingly difficult to get a deal done, but the size of the pie wasn't necessarily increasing. And then at the same time, this was before agent level 1 and 2 had come out. It was really easy to get an agent's license, so the competition was higher. And I realized that we'd see things like the market move, rates would shift, policies would be introduced, and I had no idea why, because I think that there was, at least back then, there was a lack of sophistication within the space. We didn't really know what a Bloomberg terminal was. We had no idea what capital traders were doing. We didn't even know where lenders were getting the money from. And I wanted to change that. So in 2018, I made the switch over into the capital markets side. And it kind of Buzz Lightyeared, falling with style into more and more of the MIC involvement, into the capital raising. And I've now been doing this full time in the MIC space since probably late 2018. So it's coming up on about 7 years now.
I mean, let's just start there. I mean, understanding MICs, their role in private lending, just private lending in general. Like, why don't we just start with what is a MIC? I mean, most of our listeners should know that, but maybe just a brief overview of the mortgage investment corporations and their role in Canada's mortgage ecosystem.
Yeah, absolutely. So we, as the mortgage market, we actually use the term MIC a bit colloquially in the wrong way. So a MIC is a specific tax structure within the Income Tax Act. The Mortgage Investment Corp is meant to have a flow-through organization so that all of the returns are the tax burden of the individual investors. But we use MIC as sort of a catch-all for all private lenders that are privately held. So you can have, I think the more realistic term is MIEs, mortgage investment entities, and they can be structured as mutual fund trusts. They can be structured as GP or LP structures. There's a number of ways to do it from a tax and ownership perspective, but colloquially, the term MIC is really just a quasi-institutional or a somewhat professionally run pool of funds that lends on its own criteria.
And I mean, they obviously play a critical role in our space, right? Like it's when you think of a mortgage broker or just a Canadian borrower in general, now more than ever, like Derek mentioned, maybe we can just discuss that. Like MICs do provide, alternative lending solutions, and they do fill gaps in traditional, mortgage financing. Is that, what are you seeing to expand on that?
Oh, very, very much so. When I had started, I think we probably had less than 5% of our business would go to mix. I think the average broker, even if you were always prime lending, say 10, 15 years ago, you'd probably see a good 30 to 40% is now going private, just because the banks and the monolines are having to shrink their credit box. So if I were to, look at my crystal ball and see what's happening within the mix space, I wouldn't be surprised if the market simply demands that it 2 to 3x's over the next few years. Simply again, because all of the credit profiles that we would have typically sent to the banks when we were in better economic times no longer really fit that mold. And, OSFI is tightening. Chrystia Freeland didn't really like mortgages. Peter Rutledge doesn't really like mortgages. There's a lot of risk I shouldn't say that, but there's a lot of exposure on the books from Canada's mortgage bonds. So I think that we're just starting to see this cascade coming down into the B lenders, who are then off risking and bringing it down into the mix space. This is going to be a fantastic few years for mix, just organically.
Yeah.
You bring up a good point. If we put a broker hat on, there are a ton of brokers in our industry that primarily focused on prime, right? And they've done well with that. And over the course, especially since B20, funny enough, back in the day when that all happened, we actually created a brand and a business to market to other mortgage brokers, and we would fund their alternative and private business because people just weren't familiar with the products and the programs and the lenders. Obviously, that's changed a lot. People have gotten more familiar with it, but I think that there's a huge miss by any broker that is not educating themselves on private, not only mixed, but other types of private lenders and how that can benefit their clients and their database. I mean, it's like you said, many brokers are seeing at least 30% of their total business falling into this category. So, I guess, do you have any comments for brokers that are maybe not playing in this space right now?
Yeah, I think it's a missed opportunity. One, because typically they're easier deals to do. There's less credit requirements. You've still got to be able to fee fairly, but there's still a ton of revenue to be had there as well. And then it also opens up new markets, right? Like if you have a specific niche, if you're in a small town, if you're working on quasi commercial or agricultural or something for that example, there's an opportunity for you to become a specialist a lot easier. It's what's the saying, niches or the riches are in niches or something that. So I think that mix, if you've got a portfolio of mix or just a Rolodex of a couple that intimately, you're going to be that much further ahead of someone who couldn't really compete on that deal.
I think that's so important for a broker too. I mean, you talk about a niche, maybe it's a small town or maybe it's a certain type of property that you're constantly seeing. Understanding like every single MIC has their own ideal property type, ideal lending locations and whatnot. And there are, I don't know how many MICs, you'd probably know better than me, but there's got to be thousands, right? Across the country anyways. Mm-hmm. And again, like finding those MICs that are going to be able to satisfy the niches for your clients so that you can offer that, which really it's just education. It's hitting the phones, right? And talking to them and understanding and going to events and learning what's out there.
Yeah, absolutely.
I want to move into just capital advisory for mix and private lenders in general. I know this is a big component of what you're doing in your business, and I want to get into that. So, the three main pillars of advisory, and why don't we start there? Like, let's do a deep dive into your work and your experience. So, corporate restructure or strategy, like what does that look like? Like where are you finding the most need for your services?
Yeah, and I mean this is sort of the nature of the MIC environment, is that it's pretty disjointed. The infrastructure hasn't fully been built out yet because I always say it's like the Wild West of lending, right? Yeah. And so you see such a unique need when you speak to a specific MIC, whether it's to the point of corporate restructuring. A lot of them are looking to merge right now. Some are looking to sell or buy. And then just within that, you've got teams that are running sort of 50, 100, $200 million books. And oftentimes they're a team of 2 to 3 people, right? Like these aren't institutional lenders like we'd see like a First Nat or a Strive, for example. Yeah. So you've got people wearing many hats, and usually it can be a simple fix, like just realizing that your credit manager and your underwriting manager, logically you would say would be the same person, but we could actually subdivide that just for systems of checks and balances. On the advisory side, corporate restructure, it would typically go hand in hand with sort of an overhaul of the entire operation. And it's not saying that they've done anything wrong or that there's anything running poorly, but where the rest of the business model comes in from the advisory side is that we're trying to make them look better so that way they can solicit new markets of capital. It's not really just going to your typical advisors for $100,000 at a time. We want to turn this organization into something that's not just functional but really thrives and stands out, and we can exhibit the specialties of this specific fund, right? Does that make sense?
Yeah, totally. I mean, it kind of goes to the nature of like, what I guess where my question would come from is more so what is holding these lenders back from thinking that way? Is it maybe just an old school mentality, or what do you think is it?
It can be a little bit. This will probably get me in trouble, but I always say that MICs are often not run by professional fund managers. They're oftentimes mortgage brokers who accidentally became fund managers.
Yeah.
So what you've got is incredible underwriting strength and amazing market knowledge, but then you don't necessarily have, robust sophistication when it comes to capital markets. And so where we are right now in the MIC space, I think, is a bit of a legacy of where we started, which was literally just, if the three of us had a couple million each and put it into a fund, we just wanted to make sure that fund made a decent return and didn't run out of business.
Yeah.
Whereas now we're looking towards, a structured model. We're looking at a new market trend that's happening. And now there's sort of a new wave of MIC lending that's going to come up. And that's where I think, if there's not too much ego, if there's not, too many roadblocks, there's some MICs right now that are going to be absolute darlings over the next 5-10 years.
What would you say, like in all these conversations with different mix of different scale and size and location, what is the number one need that everyone's looking for right now? And I'm sure there's variance to that, but like, is it growth, or is it just getting better at, creating more efficiency within the business that they have?
That's a really good question. I mean, first of all, we need to acknowledge that the MIC space has everything from, a broker-led $10 million fund up to a publicly traded $1.5 billion fund. So to put them all into one category is tough, but I would say that across the board, they all just need more capital.
Right.
And while they don't necessarily have to grow aggressively, it's not like we're all, Silicon Valley entrepreneurs that are trying to 5x or 10x within 6 months. But at the same time, though, you look at the inflation that we've had over the last few years. If you're not keeping up with, a 2 to 5, in some years 8% growth, you're actually falling behind.
Yeah.
So growth is sort of the default, and then stagnation is slowly shrinking. Simply because property values have typically gone up, debt sizes have gone up, yield expectations have gone up. So they always need a new pool of investors coming in, especially as some of the older investors start to maybe redeem out. It's more of a hedge rather than extreme ambition or anything like that.
Yeah.
I mean, to me, that just screams some of the challenges in capital raising. And like, we talked about this all the time, having a MIC or having some, private lending arm of our brokerage just seems to make natural sense from an evolution in our business. But our fear is raising capital. Maybe we can explore some of the other common challenges that you see and how you help, companies overcome those.
Yeah, absolutely. The next biggest one I would say would be differentiation. To Derek's point, there's nearly 1,000 MICs across the board, or MIEs and overall lending entities. And if you look at their typical yield, they're 8 to 9%. If you look at their underwriting categories, they're pretty much the same across the board, same credit criteria, average beacon, what have you. So it's a pretty homogenous product, but no one is large enough to really gain any attention. There's obviously nuanced differences within the leadership teams and their markets, their broker relationships. But if I'm, a savvy investor with a very limited amount of time to do due diligence, I have no way of differentiating you from another MIC that's roughly the same size and yield. Even if, say one's Ontario and one's BC, so what, right? Investors are chasing typically one or two priorities. So within the differentiation, there's ways for us to, just as simply as saying, the leadership team has experience in other categories, or we can say, we've been through a market shock in 2022, 23. This is how we handled it compared to a competitor. And I think that overall the space competing with each other should also be seen as a bit of an issue. If you're a highly competitive, cards close to your chest MIC, odds are it's because you don't really want people looking at your book. What I've found is that a lot of the larger MICs, especially the ones that are going at a steadier clip, they are oftentimes more cooperative. So they're not pitting themselves against someone else. They're more just highlighting a really great attribute that they have.
Yeah, that's really interesting. And I think about, in our example, if you were starting a MIC or a lending company of some sort from scratch, you are trying to raise capital without history,
Yep.
other than your own personal history in the
Yeah.
business and whatnot, right? Which I think would pose many challenges, but clearly a lot of people push through that and they're successful.
Yeah. And that's why I say a lot of mortgage brokers accidentally become fund managers,
Yeah.
right? Like they start with 5 to 10 million of their friends and family money.
Yeah.
And then, someone else is interested, and then it starts to, grow from there. And next thing you know, they've got 60 million under their belt and they're suddenly running a professional operation, and it takes away from their brokerage business. You have to have mix operating as mix. You have to have brokerages operating as brokerages, and the brokerages that have mix, I think it's incredible to have the relationship, but you need to understand that they each require their own management.
Yeah.
And oftentimes these smaller mix, not to disparage, but they can sometimes be more of a distraction than they are a benefit. So if you're going to grow it.
Yeah.
If that makes sense.
I mean, it's a good point, like to kind of just in capital raising in general, like there's so many different ways to go about that. It really, maybe we can just kind of touch on like the institutional investment in mix and, bringing larger capital into mix, and what does that look like? What is the process of that? Like hedging funds, you mentioned, asset managers, family offices, like what are you seeing out there?
Yeah, I mean, pretty much the way that I would classify an institutional investor is anyone that can write a significant enough check. Usually they want to have an investment that's at least 50 to 75 million. The issues that we've seen in this space has been that, if I'm an institutional, let's say I'm an asset manager with a check for 400 million, I want to come in, I want to put it into one investment, I want to perform one set of due diligence. There's usually no fund in Canada that can absorb that much money without significant cash drag. Like your yields would plummet, your investors would freak out, it would cause all kinds of internal drama. So usually what's happened is that an individual MIC that only focuses on their own priorities, which is entirely fair, but an individual MIC won't go to those larger asset managers because the deal will just die on the table 10 times out of 10. But what we found now is that a lot of the asset managers are looking at the overall market category of Canadian mix, and they're seeing there's incredible yields. They're tied against, or they're secured against incredible assets. We've seen, a ton of security and steadiness within the real estate markets, 2023 aside. And where they want to have a major investment is more so in either diversity. So they'll now start to open up their books a little bit to 2 to 3 funds that they would examine. Or they would have drip investments where they would more so have a facility that, let's say it has a global limit of 400 million, but we'll do 50 million every 6 to 12 months or something like that. So they're getting a bit more cooperative south of the border, and Europe as well. But going back to that differentiation we were talking about, you want to know if these institutional asset managers, if they're investing because it's opportunistic or if they're investing because they're fleeing something else. So, this new Trump tariff threat that should come out, everything that is going on with the euro versus dollar, these economic circumstances are oftentimes seeing capital flee. So if you're a MIC that just says, listen, we have safety and cooperation, you're going to get something. But if you've got something that you're trying to have gangbusters yields, 14% or whatever it is, there's you can fly too close to the sun and almost seem like you're too good to be true. So there is this balancing act of expectations, cooperation with those institutional investors, but also just overall market awareness. We need overall market advocacy.
Hey everyone, Dean here. Quick timeout from the episode to share with you the ABW Tuesday Mortgage Memo, your weekly market highlights sent directly to your inbox every Tuesday. This is certainly one you're not going to want to miss, so make sure to sign up now. You can do so with a link in the show notes, or you can head to joinabw.ca and sign up there. This is a high-level summary of market developments, regulatory updates, and housing trends every Tuesday. So hope you enjoy it, and back to the show. What stands out to you from like a benefit perspective of utilizing institutional investment? For both, maybe I'll clarify that, from both the lender perspective, but also a mortgage broker and dealing with one of these lenders.
Yeah, so that's a really great question. As the MIC, it just makes sense to have a diversified pool of funds, because if you've only got one trick up your sleeve, then something happens, you're in hot water. So it's nice to have more cooperative capital, so you're never just pushing up against your lending limits and hoping to God that another $1 million comes in. But for brokers though, To be honest, I hadn't thought of it in that regard, but it makes a lot of sense to think that in sending your deals to a MIC that has more fund security or more security in their capital markets, you're going to see more consistency in what they lend, how they operate. You know, you're not going to have lenders pulling deals last minute or turning off the tap or
Yeah.
jacking rates. And then it also allows for those MICs to have more sophisticated operations as well. So they'll go into, you know, riskier categories or riskier credit profiles because they've got more sophisticated capital behind them. There's a large difference between a $20 billion asset manager and your parents' RRSPs that are in for 200 grand, right? Who's more prone to redeem when the market wiggles a little bit?
Yeah, it's a great point. Like we talk about this all the time. You know, our reluctance to maybe jump into this space is again back to the capital raising side, and then saying, hey, here we have these great products, and then we run out of money and we don't have them anymore, right? And so from a broker perspective, you know, knowing that you're working with a sophisticated entity that has, you know, lots of capital and is just always going to be there to depend on for all your clients at any time of the year or, you know, years, I think is a huge piece.
Yeah. And it's funny, when I had first started brokering, I remember we had a large, well-known monoline come into our office. I won't name names. And my dad at the time had said, you know, we don't send them business. And I didn't really understand why until when they came into the office, they had said, listen, we promise we won't turn off the tap again. We won't jack rates. We won't do what we did. And I remember sitting there as like 8 months into the industry and thinking, wait a second, lenders can run out of money. And I had no idea that could even happen. And I mean, obviously you would think of it in the private space, but never on the institutional side. So that was one of the reasons that prompted me into exploring more of this market. But I would say that today MICs are on the cusp of getting into where we saw a lot of the B lenders and monolines, you know, 10, 15 years ago. It's not unfathomable to see MICs that are going to be in the billions on that scale over the next few years. So it's nice to know that there's secure capital there because the same problems that monolines had 10, 15 years ago will eventually plague this space too.
It's such a good point. And to think about private lending on the smallest scale possible, it's an individual investor funding a mortgage, right? A broker works with their uncle, what have you, and they're placing the funds to help Johnny who needs to second mortgage to pay off debt. I know in BC specifically, regulation is getting a lot tighter around that. And for all the reasons that you just said, think about that one person that lent that money, mortgaged up for renewal. They realize they got to pay for their daughter's school. I'm not renewing you.
Mm-hmm.
Now this person is forced into another private mortgage, which increased costs, assuming loan to value is still there. So to see that all tightening up, I think that whole realm, I don't know what that looks like in Ontario, but I think that whole realm of private individual investor money is going to start to flow into MICs as well, which will only grow that side of it.
Yeah, absolutely. Especially as we're seeing yields start to match, right?
Yeah.
If I could invest in a MIC at 6%, but I could get a private out at 12, I'm not going to go into a MIC. But we're starting to see downward pressure on private money, like true individual private money, and upward pressure from MICs.
Yeah.
Yeah, absolutely. I think pooling resources is just going to make the entire industry better.
Yeah.
Let's maybe jump into some of the exploratory work that you've been doing. Advocacy in private lending is clear. You know, just in our preliminary talks of leading up to this show is just like maybe I selfishly want to better understand mortgage-backed securities, your involvement there, fintech, marketplaces, just any other related entities that come into the mix here when it comes to private lending and what you do.
Yeah. So exactly. The third arm of what I do, I call it exploratory, but more so I would just say it's my professional ADHD. And just by nature of how I market myself, I get a lot of inbound inquiries for people that are very, keen about the mortgage space, but they're not mixed entirely, right? So you'll see, prop tech, you'll see marketplaces, you'll see all of these new startups that are coming up. And curiosity has kind of led me to now start to build teams and allocate resources towards these things because I think ultimately they're going to benefit the mixed space. To go into the mortgage-backed securities, though, if you look at the entire Canadian mortgage market, it is almost 90% run and covered by government involvement. So if you have an insured mortgage or an insurable mortgage at a bank, they're all securitized into the CMB program, which is the Canadian Mortgage Bond. And then that bond is sold off. There's a federal guarantee put on it. And that's how we have such safe mortgage markets in Canada that we're selling off to foreign sovereign wealth funds or pension funds or whatever it is. For the money that's not insured, then it's on the bank's books. And even that money, to a certain extent, has exposure to the government because that's depositors' monies that are being put out. So your checking account, my savings account, and we're protected through the CDIC. So there's, again, a lot of government involvement in the overall mortgage process. When you get into the private market, it still is the Wild West, right? So there really is no formal securitization vehicle. There's no pool that's sitting there buying 50 million or 50 billion a day of mortgage debt to then securitize and sell off. So what I've seen, again, just by nature of speaking on this space, is we've seen a lot of people that have started to build the infrastructure, started to build the capital reserves. And I don't want to say that we're going to have as robust of an MBS market in the private space, but having an MBS market in the private space would give us more liquidity. It would give us more safety. It would give us better options in competition. So you'd start to see rate compressions and still better yields to the managers. Everybody would benefit from having the same infrastructure we see on the A side come all the way down the credit
that's
curve.
interesting.
They do it in the States. Why can't we do it here?
Yeah.
Agreed. Is that something you're like, I mean, without saying too much, is that something you see yourself spending more time in that space?
Sure. No, it definitely interests me. I don't think that I would start my own MBS, but I think that if there was somebody doing it, I would gladly be involved. And I am always ready to advise on any existing.
Yeah, it's very cool. I'm very interested in that. How does technology and maybe new financial products, how are they reshaping private lending?
So MICs are sort of the foreground of innovation in that sense because there's there's less regulation. So when you don't have that regulatory burden, it's a lot easier for you to come up with things like, seconds only funds or reverse mortgages. And, we've seen some new innovators like Fraction, for example. They came out a few years ago and blew everybody out of the water because they didn't have the age requirements that you would have seen at other reverse lenders. So I think that it's sort of the breeding ground of new innovative lending products. And then again, because there's so many players, all trying to pursue their own growth, their own endeavors, their own safety or securities, you get these tech players that are coming in, and it's now making room for things like there's mix specific underwriting softwares, capital markets management softwares. We're eventually going to see the ratings agencies are going to build more things in there. I was speaking with certain stock exchanges that want to have that. So just again, overall, the space currently at last estimate sits at just below 20 billion worth of private funds that exist in Canada. Yeah, and that's set to grow so exponentially that it's a breeding ground for innovation. It's exciting more than anything.
Yeah.
Just while we're on this topic of tech, I mean, knowing what you know about the private world and behind the scenes, from the lender seat, do you foresee a world where humans can be removed from that equation?
The AI nightmare. I think even if you look at the biggest bank in Canada, RBC, their auto adjudication is somewhat replacing the human element, but we still need people. And as you go further and further down the credit curve, the underwriting becomes more lax, sure, but the deal structures and the justification becomes more complex. So I'd say that the further down the credit curve you are, the more brokers are going to be needed. I don't know that we would ever replace any human elements. I think we definitely complement them. So we'd get more speed, we'd get more accuracy, but because we're all self-employed and because the market is largely informal compared to the robust RBC mortgage-backed securities and stuff like that, I think that we're never going to replace ourselves, and we're the decision makers. So
yeah, I mean, I agree. And it's funny, like we can sit here and say private is the easiest lending you can do, which is true if you know how to do it. Loan to value, property, you can kind of figure it out.
Yeah.
But there's a story to every deal. And I think that's where the human element will never be removed from private. Like there's a situation and a story to every single deal to get that lender to approve it, right? Which that will never be taken over by tech.
Yeah,
That's a great point. Before we just kind of maybe move into some practical insights for brokers and look to wrap up, like where would you say the mixed space is headed and how can brokers stay ahead of the curve?
Yeah, I think so. It's an established space in that it's been around for about 38 years ago, the Income Tax Act brought it in. I could be wrong, but so it's established in that sense. And there's larger mix that really, have a 20, 30 year track record and know what they're doing. But as a broker looking at where the mixed space is going, I'd say just organically, the volumes to the mixed space have to 2 to 3x. That's if they don't change anything from a capital markets or an underwriting perspective or what have you. If you then add on that a lot of these mix are starting to innovate, they're starting to merge, there's new other tailwinds that are going to come up behind them. I think you're going to see a massive opportunity there. And if you're in their preferred broker programs, or if you're really understanding their underwriting and being able to specialize in their product development, you're going to be a shining star as a broker. The other thing too is that because again, this space is rather disjointed, odds are that there's deals on your desk that could be done today. You just don't have that MIC in mind because you're not as familiar with them.
Yeah.
So I would say at the very least, get a better understanding of the overall MIC landscape. There's great organizations like CAMLA, ONMICA, BCMMA that are having networking events, underwriting workshops.
Yeah.
And I would say, make sure you know who's in your territory, even new entrants too, because there's a lot of cross-provincial that's going to happen too.
I wasn't going to say this, but it's a good plug actually for our speed dating events that we've done for 12 years now at a Better Way Mortgage Group in BC specifically, where we have 8 to 10 private lenders come out and we essentially speed date them for 12 to 15 minutes and rotate tables. It's about a 2 to 3, 2.5 hour event. It's a great option to then one, get face to face with these lenders, learn what they are, who they are, what they do. It's something that we're going to be rolling out in actually May in Ontario here locally, so really looking forward to that. You'll definitely be a big part of that. It's a great resource to ultimately learn, and when looking at practical insights for brokers, that's one. And I was just going to say, like, where maybe any case studies or examples that you found a broker has been able to collaborate with a MIC and do cool stuff outside of just submitting the deal.
Yeah, absolutely. Yeah. So I'll just echo that. Your speed dating program is phenomenal. And I think that the mixed space is going to benefit from that. And the brokers are going to benefit from knowing the mixed space as well. For brokers that are working more intimately with mix, I think because a lot of them are now getting to such a scale that they can offer, rewards programs and insider programs.
That's a great point, actually. Yeah.
Get into that, right? Like, make sure that you're in their inner circle. A lot of these MICs have broker advisory boards that they want to hear what you want, whether it's better comp or better underwriting, different territories, whatever it is. So make sure that if you're going to pick one or two MICs, you're intimately involved with them. And then outside of that, a lot of these MICs, I mean, half of their team or their sales team aren't necessarily brokers. So they want to hear from you regardless. They're going to want to know the pain points of your business. And then they want to help you. They're just as invested as our monolines and A lenders are. So see if they'll come out and educate your realtor partners, or they'll host events for your clients, or they'll co-brand or whatever it is. I think that the majority of MICs want to play ball. It's just a matter of actually going for it.
Yeah, great point. And I mean, from the broker side of things, let you touch on this, but any tips for leveraging that, in more detail? Like, my head goes to, as a broker, you're constantly talking about the fact that you do mortgages, you can help people buy homes, refinance, what have you. Like, people need to talk about the fact that they do private, right? And I think in every broker's head, when they're reviewing a file, even though it might look ugly and it might not qualify, some people are cautious to present private options to clients because they think it just might be too expensive. Like, you can't take that approach. You have to give the client the option. Yeah. So I guess just any tips, that you might have leveraging that side of the industry.
Yeah. So two things I would say. One is that MICs historically had a reputation of being sort of, we call them lollers, right? Lenders of last resort. And okay, if you went back 20 years ago, there was definitely one rung up from a Nicky the Knuckles kind of lender, right? You were saving someone's skin. But now MICs are oftentimes professionally run pooled lenders that have amazing complementary products that are just down the credit curve from the next rung up, which would be, a home trust, a community, or an equitable. So one I would say is, change your perception of that and get to know exactly where their products are. The other thing too is it wouldn't hurt to re-up your sophistication on the math of the mortgage, because we're still, especially coming out of the last 10 years, we're very rate sensitive. We're all about, I'll save you 5 beeps, or I had a competitor that outpriced me by 10 beeps. But it's been very easy for me to sell a mortgage that's 1.5 to 2% higher than the comparison, but the amortization was easier. The payment terms were easier. Like at the end of the day, we're in a market now where cash flow is going to matter far more than the sting of the rate. So really intimately understand what you're offering your clients. And if you don't know, just ask your mix, because they're going to have those talking points for you.
Yeah, I mean, flexibility, all sorts of good stuff there.
Renewal fees are a huge piece that come up, and when they come up and you're not aware, it's not a good conversation.
Exactly.
I mean, this has been a great chat. I want to end with just a bit of Q&A here. Not that that's ultimately what this show has been, but I have some questions. I want to kind of maybe go a bit more rapid fire.
Yeah.
But I mean, just understanding the importance of mix and how they work and process, I think, is very important for a broker when selling clients these types of products, and ultimately advising them to take the right choices, right? When it's right, when it's not, what is ultimately the right MIC. And that's where I'm going to start. How to identify the right MIC for your business as a broker.
Step 1, check territory. Step 2, make sure rates are in line. Step 3, understand who's actually going to be underwriting your deal, whether it's a sales rep that also underwrites or if they've got a separate underwriting team. And then get into the weeds on fees.
What would you say the biggest mistake brokers make when working with mix?
The biggest one I would say is that they expect the mix to take on all the garbage because they're private.
Yeah.
So stop burning those bridges.
Yeah.
Don't send your crap deals that absolutely can't get done anywhere.
That's a great point. It's kind of like when brokers first start working with a realtor, they just get the crap files.
Exactly.
Right? Yeah. That's a great comparable. Actually, that's a good point. I'm glad you brought that up. We know what those are like. Okay, maybe I'll end with this. What's the future of private lending in Canada?
Ooh, I think we're going to see a different mix of A to B to C lending, both in lender capacity as well as in brokerage mixes. And I think that we're also going to see more diverse capital coming in. At least that's my goal or my hope for the space, is that we're going to see more of a uniform spectrum down the credit curve rather than a chunk, then a chunk, then a chunk. So we'll see that from a tech perspective and lending and so on.
This is what I'm just going to throw out. Like, so we have which we consider prime lending. We have the alternative B space and then the private space. Do you see the private space becoming the tiers as well? And maybe, I don't know how that would look, but like, do you see any sort of adjustments there? Or is it just because people just kind of allot it as it's a C lender, a private lender, and that's what it is? But do you see that tiering out?
I think it kind of already has.
Yeah.
Like, we have mix that are already going out and labeling themselves sort of B-.
Right.
And then we have other mix that, again, are just sort of above that pawn shop, Nicky Knuckles kind of lending.
Yeah.
And so there's, I wouldn't say it's formalized, but there's definitely a vibe.
Yeah.
Near B is yeah. Absolutely.
Yeah. So we're seeing that come out. But I think that what will really lead that change is more so brokerage culture. So I think within your brokerage, if you're specializing in private, which wink, wink, nudge, nudge, you should start to look more into this. But as private becomes a larger portion of your book, you're probably going to have your own classifications of, private A, private B, and so on.
Yeah. Yeah.
I got one last question. We were talking about the future of mix. I just wanted to touch on the regulatory side of this. You touched on the Wild West, which to an extent is still somewhat true. But there has been a lot of regulator changes over the course of the last 5 years in the MEC and private lending space. Do you expect that to progress? And do you have any insight into that?
Yeah. So, I mean, across the board, we saw FinTrack came in with a heavy hand last year. That also impacts the mixed space from a reporting perspective.
Yeah.
I think just organically, because they're going to need more capital going forward, the level of sophistication of that capital is going to require better reporting and, sophisticated underwriting, sometimes a lot of automations and systems that they can put in. So I think it's not going to get easier to run a MIC. I think it's going to be easier to run a good MIC. So, my tinfoil hat, I think we'll see a lot of M&A in the space. I think we'll see a lot of the smaller guys either shut down shop or get rolled up into larger ones. And then some of them, I think, the good are going to really progress and the bad are hopefully going to just disappear over the next little while.
Which is very similar to what we expect to see on the brokerage side.
I agree.
Okay, good stuff. I want to save this to the end. Your your plans going forward, what you're doing. I mean, you've largely positioned yourself as a go-to consultant in this space, but how are you formalizing that now, and what does it look like? What does Ben's future look like in this space?
Yeah. So what I found when I was doing consulting for Mix was that they'd bring me in for a specific project, say it was sales and underwriting strategy, and then capital raising, or they'd have me write marketing copy for their website and capital raising. And so what I realized was the entire, I guess the industry really needed sort of a one-stop shop for Mix. And so in the spring, I'm going to be launching my new firm, Dabble Capital Advisory, with the focus on being both advisory, capital solicitation, and then again, that overall advocacy for the space, because we want to make sure that if you have a new MIC that's just starting out, you need resources, or you've got an established MIC that just needs to be tweaked a little bit, we've got everything in one stop.
That's really cool. Congratulations.
Thank you.
Yeah, it's super cool. I mean, it's just right along the line what you're doing currently, and just formalizing that into a brand. And I see it as a huge requirement for a lot of folks without, putting anyone down. I mean, there's clearly, an old school mentality that I think is going to really, dive deep into that. So congrats. It's awesome.
Thank you.
This was a great episode. I honestly think for any broker, and you know what, the inner workings of these mix in this space, it is very unknown to a lot of brokers. I mean, historically, brokers have been primarily focused on prime business, just naturally starting to evolve into the alternative side. We're seeing a huge uptick at A Better Way in our volumes of how much of the percentage of volume is going into the mix space. So this was very informative. So thank you. Appreciate it.
Thank you.
Yeah, thank you.
Yeah, thanks, guys.
Awesome. Well, that's it. And on to the next one. Thanks for listening. Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children, ensuring they have easy to prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening, and see you on the next one.